Welcome, and thank you everyone for joining us today. My name is Derek McPherson. I'm a Vice President and Mining Analyst at Red Cloud Securities, Inc. And today's presenter is First Cobalt Corp, who are advancing their 100% owned refinery in Cobalt, Ontario towards production. And today's news of a government grant was another positive step towards that goal. But I'll let President and CEO Trent Mell get into the details on today's news and the other positive developments that has First Cobalt progressing towards its goal. The format of today's webinar will be an overview of First Cobalt, along with some additional details on the recent news and what we can expect going forward. And then we'll take your questions live. So please send in your questions via the chat at any time, and we'll get to as many as we can in the time allotted. First, we'll handle the disclosures, and then we'll get into it. For First Cobalt, there may be some forward-looking statements made on this call. I would direct listeners to the cautionary note on page 2 of First Cobalt's corporate presentation located on the company website. For Red Cloud Securities, I would highlight that this webinar is for information purposes only and should not be considered a solicitation to purchase or sell securities or a recommendation to buy or sell securities. And we note that it does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Please see our most recent research on First Cobalt for company-specific disclosures, and we'll post a link to that in the chat. With that, I'll turn it over to Trent to provide an update on First Cobalt. Go ahead, Trent.
Thank you very much, Derek, and hello, afternoon, I guess, for many of you. Thanks for joining. It's a big day. I was joking with Derek. This is the first time I've worn a tie since the pandemic began. I had to find them, and I'm wearing more than just jeans down below. So it's a big day for us because we had a big announcement out a couple of hours ago. This refinery that you see is located in the community of Timiskaming Shores, just outside of the town of Cobalt, about 5 hours drive north of Toronto. It's a permitted facility that we intend to expand and recommission, targeting the electric vehicle market in North America. And we'll get into a little bit more of that later, but today's announcement from the two levels of government was for a $10 million investment to help us advance this asset. So Ontario government, through the Northern Ontario Heritage Corporation, is providing a $5 million grant towards the expansion, and the federal government has provided us with a $5 million Canadian interest-free loan, which has about a 10-year term on it. And so with that, that gives us a really great couple of catalysts, I suppose, for people wanting to know how we're going to progress. I've got a lot of things cooking in the background that I'll talk about. This is a big tangible milestone that hit the market, and it's been great to see the market respond in turn. So we'll get into this as we go. I will skip over the forward-looking statement that Derek's already drawn your attention to. So in a nutshell, the big investment thesis here, there are other assets to our story. The big one in the next little while clearly is going to be our refinery, as you will see. It's permitted and it's built, and in that regard, we're pretty quick in terms of our path to cash flow and production, and it's a pretty low execution risk, given that, as you saw, a lot of the infrastructure is already there. We've got some strategic relationships. I'll talk about some. You'll learn about others here in the next few months. They're going to back us. This is an industry of giants. This is not so much a mining story. It is for the feed, but really this is an electric vehicle story. This is the first stage of that midstream that goes from the mine through refining to precursor and production and cathode making and battery cells into the EVs. And so that was the whole essence of today's announcement, is that there's a seismic shift going on in the auto supply chain. And so I guess I would count the government amongst those strategic relationships, but we're going to need partners because it is a land of giants, and it goes beyond Tesla and GM. There's the battery makers, and then First Cobalt is fighting our way into the game as well. The third, I'm not going to talk too much about the mineral assets, but I can't ignore them. There's some real value to be had there. Arguably we've neglected them over the last couple of years in a tough cobalt market as we focus on the refinery. They're going to come back into focus, especially Idaho next summer when we go back to drilling in what should be a stronger cobalt market. And then lastly, and this is very important as well, there are ESG credentials. You've heard about ESG investing. Europe is leading the way with their battery passport and other initiatives. It's really important for what we do because our product goes into an EV that has to be accountable for their carbon footprint and their environmental footprint. And very proud, you'll see, of our metrics and how we're going to be very appealing to the end user. So just a little bit, this is now dated. I think before we started the call, we traded from 14 up to 25 and on some 10 million shares. But prior to today's news, normalized, we were around 14 cents and about just a little over 1 million shares. More volume lately, so 1.5 million. if you were to look at the chart for First Cobalt, you will see that throughout the course of this year, we've been treading water around 14 cents. And I've been telling investors, warning them that we've got a number of catalysts coming. This was the first one. So I would call this Act 1. That's going to cause, hopefully, the market to revalue or reassess what it is that we're doing and what we're worth. So, but here we are, working capital, we're fine for the next 10 months or so. We now have money coming in. We have other sources of financing. So none of this really stresses me. The only thing I'd highlight is the shares outstanding at 400 million. That's a lot of shares out for a North American company, especially one that aspires to grow its U.S. institutional base. So at some point, we'll fix that. We can do a rollback, but you don't do that in isolation. You got to do that on the heels of a catalyst or two. So at the right time, we'll fix that, but in a way that plays into a strong share price. So stay tuned. Otherwise, I'm happy with everything there. Derek picked this up last spring or early summer, and it's certainly been the most active in terms of coverage for our company. Just a quick word on the management team here. The left-hand side, all of us come out of bigger companies. I was an M&A lawyer, securities lawyer at one point, but started my mining career at Barrick Gold. I worked at Sherritt Nickel, Sherritt International, which also, of course, has cobalt in its portfolio, North American Palladium, Orico Gold, and then a little bit of junior mining, a little bit as a banker for a couple of years. And then when I go across my team, it's the same. When you look at Ryan, Peter, Mark, and Frank, you can count Inmet, Falconbridge, First Quantum, and I guess Glencore today, ultimately in their portfolios. And so that was kind of by design. Mark Trevisial, I'm going to highlight him. He's been with us 4 months. He ran Glencore's smelter in Sudbury. He was a superintendent at the Kidd Creek zinc plant. So a really good process guy. He's going to be leading the execution of the expansion facility and bringing it into production. Great network. He's been a breath of fresh air to our team, given his hands-on experience with what it is we're creating here. Board side, a couple of miners in John and Garrett, John Falconbridge and Vale. So you can see through our team, we do have a lot of overlapping or historic relationships with what is now Glencore, and that figures into a strategic relationship, one of the more important ones we have going. Former governor of Idaho, Butch Otter, Susan, a friend of mine who's got phenomenal ESG credentials, and Henrik Fisker probably needs no introduction if you're in the EV space at all. And so here's a picture of the refinery. This was taken last summer, and so it's a facility that was shut down properly. Everything is in great operating order. Senko, our EPC contractor and our study lead, came in and we restarted all the equipment. So the electrical is in great shape. You can see the overhead crane, the tanks, equipment. Excuse me, some of these will be repurposed. It's just too small. That's the big thing. But we've got a heck of a head start here. So we're going to take this from 12 tons a day up to 55. So as you can imagine, the filtration presses you see there and whatnot are going to need to be expanded fairly significantly. So before I go to the refinery proper, let me talk about the ESG strategy. So that's, of course, environmental, social, and governance. When I started my career, we talked about CSR, right? Community social responsibility. We talk about health and environment. This is a little different, right? Because this plays into Paris Accord, it plays into CO2 emissions, and it really plays into a cradle to grave life cycle or footprint of the product that we have, whether it be a phone or a car. From the moment that product is mined and transported and further refined and processed and transported again and then ultimately recycled, consumers today and increasingly legislators want to know what the environmental impact is of your product. And so I'm going to start that way. If you look at the LCA environmental impact, we did do a life cycle assessment report. It's a third-party report, and it measures a bunch of criteria, CO2 being perhaps one of the more sort of prominent categories. And we really came out strong across almost all the categories. We've got a bit of a learning tool now that we're going to keep building on, but look at our CO2 emissions. The benchmark that we used was the Huaihou facility in mainland China because they publish data. Because we're on a hydro grid in part, our CO2 emissions are going to be half of what theirs are today. Water consumption and so on down the list. So the impact of our product, that matters because when it goes into a Tesla, for instance, they publish their sustainability report. If they can lower their CO2 emissions consumption across their supply chain on this order of magnitude, it's a pretty impressive vehicle you're putting onto the market. And so this appeals to the end users that we're going to be selling our product to, which is EV manufacturers and battery makers. And then bumping back up a category here under responsible sourcing. Look, cobalt, most of it comes out of the DRC today. And when you look at we're no different. When you look at the battery market specifically, the cobalt in the DRC, it comes out of the copper operations. They make a cathode, and it's a cobalt intermediate product called hydroxide. And it's the perfect material to basically leach and produce a battery grade salt called the chemical form is a cobalt sulfate. And so this is where China gets their product, and they're 80% of that market. This is where Umicore in Finland gets their product, and we're no different because, frankly, the North American market in terms of primary feeds is going to take a little time to mature. And so if we're going to do that, you've got to do that obviously in a responsible way. You've got to show transparency in your supply chain. You're no doubt well aware of the human rights issues in the DRC, including child labor. And so the standard that many of us are adopting is the RMI, the Responsible Mining Initiative, which is follows the OECD sourcing guidelines, UN principles on human rights. And so, day one, we got to certify under that. That's just kind of table stakes to get everybody comfortable that you're not going to be tainting a brand by virtue of product that runs through our refinery. And how we get there, nothing against artisanal mining, and there are initiatives to try to make artisanal, to try to differentiate between, I guess, ethical source and non-ethical source. But we just can't play in that space as a small company far removed. Our strategy, as will soon become clear, is to buy from two of the bigger cobalt sulfate or hydroxide producers in the DRC. And so you'll see that Glencore, everybody knows we've been working with them, and there will be another partner. And that alone, if we're shipping from mine head of a big commercial operation to our refinery, it gets you a big part of the way there, and then you overlay our certification, and you've got a pretty good transparent supply chain. And then I talked about this at the press conference today, just the impact of our product. It's not just that we're making EVs, but the EVs themselves, not just our own footprint, but the EVs themselves are really contributing to Canada's commitments on global emissions. So we're taking 3 million tons a year of CO2 out of the atmosphere every year based on some 500,000 plus EVs that are going on the road as a result of cobalt we produce. And that could keep growing. There's opportunities. I'll talk about it. I hope I remember to talk about it, how we continue growing this refinery. But first, a little bit of this is a cursory history lesson. This facility that you saw on the cover page, and you can see it again here, it was commissioned in '96, been on care and maintenance since 2015. Why? Well, it was a custom feed facility built in the Cobalt Camp because there's 100 historic operations there and tough feedstocks. We're talking arsenic-rich material, some waste rock. There are some waste dumps. There's tails, and it took in product from Cuba and across North America. What made this facility somewhat unique is it had autoclaves and it was able to treat arsenic. And it's an unfortunate reality of North American cobalt deposits that almost without exception, and we have an exception to this rule, almost without exception, the cobalt plays have high amounts of arsenic. And it makes it very hard to process because many facilities aren't permitted to accept high levels of arsenic. This facility could do it, or did provide us with a $5 million loan about a year ago. $60 million capex is what that feasibility study tells us in terms of the cost to get ourselves to production. And as part of that relationship, just to pause on the commercial side, Glencore, at the time, the thought was they would provide a big chunk, if not be another 67 million Canadian to fill that out, and hopefully that'll come together in the latter part of Q1. But as a result of that, we're not dependent on our partner, on our feed supplier for the capital, and the relationship has changed as well. At inception, we were talking about a toll arrangement where we would take their feed, 100% of our feed would be Glencore, and they would then market the product. And back in early November, we signaled a shift in our strategy whereby we would be market facing. And so we buy the product and we sell it ourselves to OEMs and cobalt traders and the like. And the advantage for our investors, of course, is much better margins, as you'll see here shortly. You're facing the market, you benefit from a strengthening cobalt market. So and a couple of notes down below here, you'll notice $78 million, the replacement value of the asset. I mean, that's one of the things that gives us a really good head start. But I would say even more than that, frankly, is just the fact that the roads are there, the power lines, most of the buildings. You've got all that infrastructure plus the permits, so you can really get off to a running start. We finally start construction. And so again, the feasibility study highlights the production profile is 5,000 tons of cobalt contained, which equates to 25,000 tons of cobalt sulfate, because that sulfate product grades about 20.5% cobalt content. The capex, I've spoken to it. We're going to be a little bit more discreet, I think, as we go forward on what our OPEX is. But we were publishing a $2.36 a pound cobalt cost per pound of cobalt produced. That is competitive with the market from what we've been able to glean on an opaque market in China. Anywhere from $2 to $2.80 is where they sit on the cost curve. And so at $2.36, we're down towards the bottom quartile. We don't quite know where we sit. I think we can get better than that, but we'll see. And we might play our cards a little closer to the vest here on that as we move forward, because it is a very competitive market. But suffice to say, we don't see ourselves being a high cost operation by any stretch. And overlay with that the ESG mandate that we're going to have, I think we're in good shape next year as we start talking about offtake. So now back to the margins. I mentioned to you, now that we're facing the market and we're buying our feed, we are able to point back to our refinery study, our DFS that we put out in May, showing what the opportunity is. And so we use a long-term price assumption of $25 cobalt, and we'll talk about that in a moment. We in the DFS were using a feed payability factor for the hydroxide of 70% of the prevailing cobalt price. We've raised that to be a little more conservative and to reflect, frankly, a tight market with COVID and stainless steel on its back, with aerospace kind of still stranded. So we made it a little harder. We were showing about a $40 million USD in annual margin. Here we're showing 35. I think the takeaway here is there is good margin to be had to both to finance this on a debt basis and to whether it be strong markets or even the down market. So today in China, we're sitting somewhere north of about $18 a pound cobalt. And so you're still into the mid 20s, maybe a little stronger in terms of your margin of the refinery. And what is a pretty modest spot price. So again, it gives us comfort that as the market strengthens, we're coming out of a 2-year bear market where we're feeling pretty good about our prospects. Particularly when you look at production being, 18, well, a little more than 18 months, maybe 20 months away, it lines up really well with what people see in terms of a growing EV penetration and the cobalt price. So this is just a quick overview. You've seen this picture now a couple of times in a real photo. Here's the building. Here's the warehouse out the back. And so we will have a new solvent extraction building just by virtue of the scale up of the facility. So a separate building there and a separate building for the crystallizer. And so just to pause on the flow sheet, there's nothing conventional, nothing sort of unconventional rather about the flow sheet. It's customary. It's you're taking product in the door that's already grounded up. It's in big bulk bags. You put it into a leach. Then you go through your solvent extraction circuit. You remove the impurities, and then you extract the cobalt. And what is new for this plant is that once you have the cobalt in solution, you've got to crystallize it into that pink powder that you saw earlier to make your battery grade cobalt. So that's a new unit, but not new to the industry. We had the feasibility study reviewed by a global team, SGS, Senko, Glencore Technology, some of their operators, 15, 20 people over the space of a few meetings and many hours. And I think everybody agreed that the flow sheet was kind of low execution risk, and it was more about identifying opportunities, surge tanks and other sort of efficiencies, just to build in some redundancies as we move forward. So, the biggest, I think, element the market wanted to see from us in terms of de-risking this asset is, of course, the financing, and that starts today, and then the feed contracts, which are, I will say, well at hand, but not yet ready for public disclosure. And so here we are, near-term catalysts. I've highlighted today's announcement. I've been signaling here for a little while that we'd be talking about sort of the first step of our financing, and 10 million Canadian at a 77. While it doesn't quite break the back of the bulk of the financing, I think the government investment is significant, and it's resonated well with our partners and the other lending parties. And it's also backed up, I would say, by some really good support. We got a SWAT team, as Minister Rickford referred to it today, of people that are helping us with the permitting process and just treating this like a strategic asset that I think it is. And it's been a real treat working with the Ontario government, and the financing is just one facet of a bigger partnership that we've formed with them. I'm still working on feed purchase contracts. We're running out of real estate here. You may have news before the end of the Q4. You might not, but feeling very, very good about that. And that's the other thing we really need to show the market. And I can tell you, I'm not losing any sleep over that. As we enter into Q1, then it's the bigger financing, back to CIBC and the banks and the other funds that we're talking to. We need to winnow that down from the handful that we have down to one or two to due diligence and settle on terms. Again, quite pleased with the interest for a startup and the money that we need. And then a little bit new, you're going to start hearing us talk a little bit more about battery recycling. It's something we've been holding off from talking about because we had our hands full and we didn't want to confuse the market. But the reality is this is a huge potential blue ocean for us. It's a market that nobody really does well yet in North America. A lot of startups are trying to get into it, doing the battery recycling and doing the shredding and producing what's called a black mass. And the black mass, it's just cobalt, but it's an obvious add-on to our facility because right now we've got a lot of batteries coming out of cell phones and laptops and power tools and kids' toys. Not so many EVs yet, but if we can start to penetrate that market, I would put to you that nobody is doing it very well on the continent. And with a hydrometallurgical facility like ours, where you're putting everything into solution as opposed to pyro and furnaces, our cost curve and our recovery should be better than the existing competition. So stay tuned. We'll start to do some work on that. Not sure we'll start with that out of the gate. That might be year 1 or 2, but we got to do some work. And I think if we could stake our ground in that, it'll serve as a barrier to entry for entrants to try to replicate what we think we can do. So sorry to dwell on that. Heading to Q2, what I'd like to try to do is get all the permit amendments that are now in, or just about in. Most of them, we think we can have those back in the spring, given that we're building off existing permits, and it's a brownfield site, and that could put us in a position to start construction as early as June. Now, before June, with some money in the bank, we'll expect to do some engineering and some early lead, sort of long lead rather, orders of equipment such as the crystallizer. And then the balance of the year will be likely growing the team. I got to bring somebody on the commercial side to help me with the offtake contracts. This is a big universe of people, and I want to start knocking off. I've got a buyer of the Cobalt, a bit of a backstop that we'll talk about in the new year, but you want the OEMs, and it's likely more than one. There's a chance, given how early we are, I suppose, in the North American landscape, that we ship some of this product offshore as far as Asia and likely Europe, which is fine, but it's a big universe of OEMs and battery makers and cathode makers, and so we'll start chipping away at that. But first, I wanted to demonstrate, one, that we have the capital, and two, that we've got a very desirable mine feed with a good carbon footprint, and all of that's just going to make for I guess more interesting discussions. And then when it all comes together, second half of 22, is that August, September, October? I'm not sure, but let's call it in the fall. We'll commission and get our first product, and that'll become clearer as we make our way with our permits and pre-construction activities. So stay tuned on that. It'll happen pretty quickly. And when you look at what's required, given those buildings, a lot of it is engineering and it's equipment and manpower. So not a lot of high risk things to be done there. So briefly on our Cobalt Properties, I won't spend too much, but we do have two core assets on the mineral exploration side. So Iron Creek is the flagship. It's a primary cobalt deposit, of which there are very few in the world. Usually this is a byproduct of nickel and copper mines. So the cobalt that we have there, the byproduct is copper in this case. And we've got currently 900 meters of strike, as you'll see, open in all directions, and just beautiful. We've got patented property, we've got 3 adits, we've already got underground development, as you can see in that image. So again, another sort of quick potential to cash flow, and a really continuous mineral deposit that doesn't have the arsenic that you see elsewhere. And then secondly, we have the Cobalt Camp. So the refinery is located in the camp. We have 50 of some 100 past producers, silver as well as cobalt. I would say in the current precious metals market and the performance we've seen out of silver of late, we've had a number of inbound inquiries, and so we've advertised that we've got a process underway. I'm feeling quite good about that. Looking to maybe monetize some of these assets or partner others. And the idea being here is if it's our third asset, and it is, we're not going to have a chance to get to it anytime soon. And while we still believe in it, I'd rather have a share of something that's moving forward than 100% of something that's standing still. And so stay tuned on that. That could provide some capital as well for the refinery that would further minimize the need for dilution or debt financing. And then just a word on Idaho. I won't spend too much time here, but this is the contour of the Idaho Cobalt Belt. And we have a pier, we do have a Jervois here, the former Blackbird mine, and all of these deposits. I would predict that as the cobalt market strengthens heading into next year and certainly 2022, there should be more activity in this camp. I think we've got one of the better deposits just because we don't have the arsenic and we've got really thick mineralized intercepts. But I think there's a lot more to be done in Idaho in the years ahead. And here's our resource. There are, there'd be 7 or 8 deposits that are higher grade than that, including the ones in the DRC. But this shows up really well. And with 30 meters of strike length, from a mine design perspective, you can get some good thick stopes to be mining and not have to be too selective. And then some regional exploration. Stay tuned. In January, we'll give you an update. We've done some geophysics here. This Iron Creek footprint is up here. We had ground cover to the west. We were getting high-grade copper intercepts and weren't sure quite what was here. And then we had a fault to the east where the high-grade cobalt was. And so some geophysics has given us a few clues. We also have known mineralization at Ruby with some strength here. And once we get the financing in place for the refinery, expect that we will be drilling this next summer because there's our last drill campaign was merely to infill drill. We wanted to demonstrate good continuity in between previously drilled holes. Now it's time to step out and just see how big this thing can actually get. And then Cobalt Camp, just a map here. So the refinery is sitting right around the town of Cobalt. All these dots, these are the 100 or so mines that you see, and the orange as well as the Kerr circle is the land package that we control. And you can see up here, I'll just highlight this, up to 1,400 grams of silver over 2.5 meters. I mean, we get these crazy bonanza grades up here, and that's how this camp was born in 1904, building a railway, native silver on surface, and there were suddenly 10,000 people mining the area. Mostly 1919 to 31 was kind of peak production, but this was a kind of a boom bust camp back then. I think there's a lot more to be done here, and with the right partner, I'd love to get back at it. We drilled at $10 million, drilled 35,000 meters, and I think there's more that can happen here with some time and some focus. And then you can just see some past production here around Kerr. So Derek, I can pause it there. That's probably a pretty good summary, and happy to take any questions.
Sure, Trent. That I think that makes sense. And yeah, we have a bunch of questions from the audience. So let's start there. I guess a couple of questions with respect first to the. All right, I'll start at the beginning. So, anyways, first question is on obviously, I guess somewhere you worked previously is Shared International. They have a refinery in Fort Saskatchewan. What differentiates First Cobalt? What First Cobalt's working on in Cobalt, Ontario, versus that facility?
Okay, yeah, two things with Shared. A great facility, and they've got their own IP. So Shared developed their own process over the years. They're dealing with nickel laterite, and we're dealing with a copper cobalt feed type. So it's a very different type of feed, different process. There is hydrometallurgical. You do have the issue, the challenge we would have with a Shared, for instance, is we've got a footprint in the U.S. They can't touch the U.S. And it all, unfortunately, comes back to the Cuban embargo and the fact that their main operation is there. They're producing, is it rounds or pellets? I guess they're producing a pellet, which could be melted, could be dissolved into the chemical business, but typically would be sold into the metal market. And so when you think of the final product for cobalt, you've got the traditional domain of alloys. You think of big jet engines and gas turbines where you need good heat resistivity. That's only about 30% of the final product of the end user market. What we call the salt side is the other 70%. And so we're targeting two different markets. We're targeting the battery market, which is the bigger of the two, notably the sulfate market. So two different applications, obviously both in Canada.
Right. I guess following on from that, sticking in the cobalt market, obviously there's been a lot of discussion about potentially thrifting out cobalt out of the batteries. And battery chemistry is constantly evolving. We're at a very early stage in that technology, but maybe talk a little bit about what you're seeing, what some of the studies that you're looking at are saying about cobalt and the battery and the future of that.
Sure, and I could spend a lot of time on that, but let's deal with the two things that you could say could create headwinds for cobalt. One is absolutely thrifting. The first inception, the main battery people are relying on for long range, which is what the Western world wants. Long range batteries is the NCM, nickel, cobalt, manganese. And at first inception, there was about an equal amount of nickel, cobalt, manganese in that battery. So we called it the NCM 111 to reflect the ratio. We're now sitting at a 622. So we've gone to 60% nickel, 20% cobalt, and we're looking at 811 increasingly. So, down to 10% cobalt. I think it's net positive because nickel is a more affordable way to get you the long range. But whereas you need nickel for your range, you need cobalt with nickel. Cobalt has a stabilizing element in the cathode. It keeps the battery from overheating, and it also gives you the cycle life. Your 10-year battery. Nickel just doesn't have the same properties at high temperature. You'll create dendrites on the cathode and issues of degradation. So cobalt's essential, but it's expensive and it's more scarce. It's not going to zero. But there is a cobalt-free battery out there. We're seeing it in China. It's called the LFP, lithium iron phosphate. That's your low-range battery. That's your 100 kilometer, 150. I think it's getting better. CATL, maybe they're up to 200. I truthfully don't know. But that's not viewed as a viable battery for most of the world. And frankly, the world is growing so quickly in EV adoptions that we're going to need all the help we can get. And so with those two headwinds, you look at Europe this year. Europe, I think their auto sales last I saw were down like 25% year over year, passenger sales. Electric vehicle sales are up more than 100%. And I'll come to America in a second. So when you look at the aggregation of thrifting and LFPs on the one hand, but a growing market, we're still only at about 3% global penetration rate. You want to get to 10, you need a lot more batteries, a lot more cobalt. So there's room for everybody. Benchmark Minerals would project 57% of cobalt right now going into batteries, cobalt production. They see that going to 72% of cobalt going into batteries by 2025. That just shows you where the world is going. And if I may, Derek, just if you'll allow me, I look at Europe today and how quickly that changed. 1 year they got bigger than China. Maybe China's catching up now. But through a carrot and stick approach, EV adoption rates in Europe were beyond our expectations. I think we could see that in North America, and I think most analysts don't give enough credence to it. And you look at the Biden administration with a $2 trillion green energy plan, joining the Paris Accord on day one, and so on and so forth. That's backstopped by some very obvious realities that would go forward regardless of who was in the White House. If you buy an EV right now in America this year, you're going to have 16 models to choose from. Next year, that's going to jump to 39, so more than double. And in 5 years from now, there's going to be 121 different models of electric vehicles. And so the world is going that way, irrespective of policy, but you're going to have the policy backwinds, or tailwinds, I'm sorry, behind you. So I think things are going to change pretty quickly.
Yeah, and that's I think I wouldn't disagree, and actually probably oddly enough, the fact that the cobalt is going to have a lesser part of the battery is probably what keeps it in the battery, because there isn't that much cobalt in the world, and would very quickly have a very significant price spike and be uneconomic to be included, and would get pushed out a lot quicker if that wasn't the case. You mentioned the incoming Biden government, and obviously it's very positive that you've got both the Ontario and federal Canadian governments to support First Cobalt and the restart of the refinery. Do you think, obviously you have a footprint in the U.S., do you think that there's a chance that you get some support out of the U.S. government and their $2 billion green energy plan?
I think there's a decent chance. We joined the Critical Minerals Institute a little while ago, which is funded by the Department of Energy, and they've indicated their support to help us with our metallurgy. As you know, Derek, our cobalt reports into a pyrite concentrate, and we need to understand how we can address the mass pull and make that more economic. So they're going to be funding that with University of Colorado. DOD and DOE are both very active. So a lot of agencies. I candidly owe it to my shareholders to, as a team, we got to get smarter on what's available out there. But I do think there's something there. Before the election, the Biden administration signaled to miners that when it comes to battery materials mined in America, so cobalt, lithium, and so forth, that they would try to maintain the current favorable regime towards permitting and advancing the projects. And so it's a double win, right? I think if you can implement policies that include tripling the number of charging stations, cash for clunkers, a Green New Deal, and so forth, and overlay a favorable permitting regime, I think it plays well into our hands for both parts of our business.
Right. Yeah, and I think that support more likely would come for Iron Creek than the refinery and Cobalt, but who knows? And then just along that lines of maybe sliding back to Ontario a bit, and probably a good question for those who live in Cobalt, about number of employees that the refinery is going to support. How many employees do you guys have now in Cobalt, and then I guess how many do you anticipate growing to for full production?
Yeah, I would say full time today. I mean, when we were exploring in 2017, if I count contractors that were dedicated to us, we had probably 50 people, and that's probably winnowed down to about one right now. A lot of our work is contractors, right? It's Asenco, it's SGS. Mark Trevisial is actually out of Sudbury. That could change pretty quickly, but as we move forward, let's look to June here. Assuming we start construction, I envision maybe 100 people or so on the site. When it comes to construction crews and the trades involved, it's going to be a mix of people in the community and people outside. It's a bit of a transient function anyway. And then when you go into production, we're projecting about 46 full-time jobs, unless we start expanding into battery recycling and whatnot. And then there's a multiplier effect. I think Ontario Mining Association, at least in the mining side, says for every mining job you're getting, I don't remember if it's 2 or 3 more jobs in the community, right? So I would say Temiskaming Shore stands to benefit from that. So if 46 becomes 150 or 200, that would surely extend to North Bay and maybe Timmins and Sudbury and the broader region. So not an insignificant one. I'd also add that unlike a mining operation, the refinery doesn't have a mine life, right? I mean, if I look at the Port Colborne refinery that Vale has in Southern Ontario, it's been around 100 years. And so as long as you can keep bringing the feed in, we've got rail, we've got road, this facility could live for a long, long time. And you're creating career opportunities and not merely a 5-year job.
Right. Of course. Now, thinking about the feed that's going to come into the refinery, question here on where the feed is going to come from. What they're asking, and maybe talk about initially and where you see it going to long term. How much is coming from Canada, the U.S., and then potentially offshore.
Okay. So right now, when you look at where cobalt comes from for EV batteries, it's almost 100% DRC. And it's because I mentioned earlier, you've got nickel mines and you got copper mines, and just the way the processing goes, cobalt out of the nickel operations typically gets refined into alloy grade products, so on the metallic side, whereas the copper operations, the DRC produces as hydroxide, which gets refined into the salts. And so, China with 80% of the cobalt sulfate market, that's all DRC feed. And again, Umicore as well. If I look at their Finland operation, that's all DRC. Now, there are exceptions. You can certainly take an alloy product and dissolve it back into a chemical form and create the salt. It's expensive to do it. So we're going to be no different. I think right now, we've got the miners have work to do. All of us do to explore, discover, and build new cobalt operations. I think Idaho has some good prospects, but it's still 2 or 3 years away. So 100% of it is going to come from the DRC for the short term. I'd love to see North American feeds coming into there. It's just going to take a few years. I would anticipate, though, that before we get North American feeds, you're going to start seeing the black mass, and we'll get into that closed loop supply chain even sooner. So that to me, by far, is the most exciting part of my business, to grow that recycling arm. It's what the OEMs want to hear, and that creates a closed loop domestic supply chain that's hard to replicate.
Right. Okay. I guess this might be a question. I don't know if you'll actually be able to answer this one, but I will ask it anyways. Are you speaking with Ford and Fiat and Fiat Chrysler, who are both building / refurbishing large EV plants in Ontario?
I am talking to a bunch of people. Yeah, we've got, so our and this is where I need a commercial individual, because I've been I've been fortunate sort of being on the pre-COVID battery supply circuit. I've made a lot of contacts with battery makers on through to the OEMs. OEMs are tough, right? Because historically, and I'll give you the story, and then I'll come back. Traditionally, OEMs are relying on 4 big battery makers: CATL in China, Panasonic in Japan, and then in Korea you've got SK Innovation and LG Chem. And it's off the shelf, right? I need a battery, being simplistic here, and then it goes to the car. Now Tesla and VW and maybe now GM and perhaps one day Ford are starting to rethink that. It's the most expensive component of your vehicle is the battery, and the one big variable that's going to impact the cost or your margins rather in your vehicle is going to be the raw materials, and it's hard to lock that in. We're not going to give a fixed price contract to anybody we sell to, and so right now there's this interesting tug of war where OEMs are trying to reach over and around their battery maker. Think, I want to go to that mine, or I want to buy from you First Cobalt or you Glencore on the mine feed and direct it through the battery supply chain. So that whole ecosystem, I think, it's not going to blow up, but it's going to change. The battery makers are going to remain, but look at the Ultium JV with GM in Ohio. It'll be more JVs. It'll be go-it-alones like Tesla. And so I would say we're caught in the middle, but we're having dialogues right across that supply chain. I can't name anybody, but I would think by sometime next year you'll start to hear a name or two. We've got, I will say, probably a half dozen NDAs with OEMs in place.
Right. I guess that feeds into what my next question will be. Obviously, today's announcement is about 10% of the funding to start developing those offtake agreements and partnerships, or just over 10%. Where do you expect the rest of the money to come from? How advanced are those discussions? And then what form do you expect it to take, whether it's equity, debt, or potentially offtake financing with one of these groups that need that security of supply?
Yeah, I would say if you look at US dollars, it's 60 million US that we're looking for. So today we got the equivalent of, I don't know, call it seven and a bit. That takes us down to 53. We've got the silver process underway. When I look at how we're going to raise it, I really don't want to dilute my equity shareholders any more than I have to, if at all. So Ryan, my CFO, and I look at this. We're comfortable with about 45 million US of debt as a rough number. It doesn't leave a lot if we can monetize some silver assets and get the support from the government. So there could be a little bit of an equity. Sure, you'd look at maybe a stream or a royalty if it made sense and if it was kind of limited in time. But most of this is going to be debt. There's been talk about maybe green loan qualification, which for a startup is great because it gets you a more attractive coupon. And then you've got your big private equity firms that we all know that'll lend you money at a much higher coupon. So my preference would be a big bank, but I think we've got enough optionality in the final list of candidates that will get her done. I should say that so confidently, but confident we'll get it done. It's just going to be a question of what the cost of capital is going to be for a debt piece.
And I guess that's the challenge is optimizing that opportunity. Now you mentioned it a little bit in your discussion there. Obviously, something that we've been noticing at Red Cloud is that there's been a real push for green themed investments, which First Cobalt is in spades, particularly in the U.S. So have you seen some sort of non-traditional either lenders or investors that are starting to look at First Cobalt as an opportunity to get that green exposure that they're looking for?
Yeah, I got to say they're starting to come to us now, which is good because, as you know, I've been in the mining side for 20 years, and so for me to go and seek out ESG investors, it's hard to figure out where to go, right? And a lot of them are new. So we have one group. It was actually a mining fund that's creating an ESG fund, so they want to bring ESG and resources together under one umbrella and target investments that way. So yeah, the conversations are starting. I'd say they're early. The ESG investing universe, I think has a reputation for being a little bit of a Wild West. I mean, really, you can invest in a tech company and pat yourself in the back that you're not adding to a carbon footprint, but that's not really meaningful. ESG with a company like ours takes a little bit more work and diligence. I think investments like today, if we can increase our liquidity and our market cap, we'll start to qualify for diligence at some of these funds. So I would say yes, it's starting. I got a little more work to do. We have a little more work to do on our project, but I think that'll feature prominently in maybe the latter part of next year.
Yeah, I think that as you advance, and oddly enough, some of these ESG funds are very, very large, which makes it difficult for sometimes for smaller companies to fit into the mandate, whereas most of the companies are actually smaller.
That's right. Chicken and egg problem.
Exactly. I think just moving on, and I think this is moving on to your Cobalt Properties. Question from the line here on drilling plans at Iron Creek. Obviously, you guys have did some good, I think it was geophysics and subsurface work at Iron Creek this year. What's the plans for Iron Creek? I guess for 2021 as far as work goes.
Yeah, so we've done 2 drill campaigns. We bought US Cobalt in 2018, middle of 2018, and we took over a drill campaign that was chasing up a historic resource, non-compliant resource from the Noranda and Hannah mining days. And then thereafter, we did our second drill campaign. And as I mentioned in the presentation, rather than try to grow the resource, we did a lot of infill drilling, just to give guys like you, Derek, confidence that that the resource was real, right? Continuity and grade, and it held up really, really well. And so, unfortunately, the market was falling away from us, right? We went from a really, really strong market into a bear market, and so retrenched, stopped activities, and did a little bit of recon on the groundwork. I can't wait to get at it. The geophysics, and we haven't sort of shown the results yet, but it's quite encouraging. I think we will have new targets, and even without those, we know we've got to go east. We got to test to the west for the cobalt and then copper, respectively. We know it's open at depth, and so this is just one of those deposits where, I would estimate 95% of our drill holes were mineralized. So plan, it'll be market dependent, but it wouldn't be hard to spend $2, $3, $5 million or more. It's really a function of how fast you want to go. But strong likelihood that we will be drilling again this year. One, it'll step out from Iron Creek. I want to test east and west for these new showings, and I want to test something called the Ruby Zone. It's a target 1.5 kilometers away that has many similarities. We reported some grab samples, and that could be a whole other deposit for all we know. We got to do some. We've got that permitted and ready to drill.
Have you decided on a budget for Iron Creek for 2021?
Not yet. I'm keeping it pretty loose. I want the team really. I mean, other than Frank Santaguida, who is our VPX, I want the team really focused on what we're doing at the refinery right now. Not that we can't do more than one thing at a time, but I think we owe to our investors to get this one in the bag, and we're close. So stay tuned.
All right, and then just going quickly back to the refinery. Is there a question from the line? Are there alternatives being worked on that could result in an earlier commissioning date for the refinery? Is there an opportunity to pull it ahead?
That's an interesting question. Maybe somebody who knows Mark Treviso. a guy who's going to be building it. So I would say there are. I mean, Mark's got quite a long processing career, custom milling and smelting, and we have looked at that. We initially, we back up 12 months, we were talking about an early commissioning this year, right? Effectively doing our pilot plant there. Just got a little nervous. You look at the capital required to refurbish, pumps and motors and get the electricity back on permanently and the permits. And you get worried that if you start small and you make $100,000 or $400,000 a month or something, like, is it worth it? So I would say cautiously, I think we should assume that we're going to be on this longer timeline, the stated timeline for kind of the big bang. But definitely there is opportunities that we are looking at that could get us out of the gate sooner with a smaller production profile. We just got to look at the risk reward of that. I'm not yet sold on that.
Still be under consideration as the
yeah. But I wouldn't put a lot of money on that. We'll see what happens. The recycling would be a case in point, right? That would be an easy one. It's high margin, and we've got all the equipment there in place. So that would be a great example of something. Hey, we could do that quickly. Let's do it. But I'm going to have to be convinced that that's not going to distract us from the bigger prize.
Right. Absolutely. So that takes care of all the questions on the line, Trent. So thank you very much for your time today. Except for one, and this was going to be my last question anyways. But question is, Trent mentioned that he hasn't had a reason to wear a tie all year. Does he expect to have more reasons to wear a tie this year? And if so, could he hit towards those tie wearing events? So perhaps maybe give us a little bit of an overview of if we should expect more news before the end of the year, or if and then maybe what we should expect sort of the first 6 months of 2021.
Yeah, I would hope to have at least one more piece of news to share with the market before I put my Santa hat on, I guess. Tie wearing, yeah, I mean, maybe tie wearing is more Q1, and then the jeans and the hard hat is kind of Q2, Q3. It's and if I could get my wardrobe in that sequence, I'd be a very happy man.
All right, I think that's fair to say. And the tie wearing events are again feed contracts, financing, offtake agreements, and the hard hat is the start of construction of the refinery in Q2.
You got it. So maybe the tie goes back for the offtake later in the year as well.
All right. Well, I'd like to thank everybody for joining us today. And I'd like to thank Trent for presenting. I think it was a good presentation, and it worked out. Timing was perfect considering the news you had this morning. And I especially like to thank all those who asked questions on the line. We had a lot of good questions today. Reminder that from a Red Cloud's perspective, we do have one more webinar this year, and it's tomorrow at 2:00 with Fiore Gold. And then our webinar schedule for January is starting to fill up. So if anytime you want to see what webinars we have coming up, or to see the replays of any of these webinars, visit our news and media page on our Red Cloud website. Thank you very much, and enjoy your afternoon.
Thank you, everybody.